Thank you guys for tuning in tonight and taking some time out of your night. This is for those of you who follow me on Facebook. You probably see I post a lot of things related to stats and data of real estate, and I've compiled what I think are probably the 50 most intriguing charts that I've come across to kind of explain where we're at in the market right now, in my opinion. So as I said earlier, I don't pretend to be an expert. I don't pretend to have all the answers to all the questions. One thing, I will certainly say though, I definitely am naturally curious. I'm always looking to learn, and I have a little bit of a unique insight because I'm on a couple, pieces and in the industry, right? So, I'm involved in real estate brokerage. I'm involved in real estate sales. I'm involved in having a real estate school, and then also as a real estate investor myself. So these are things that kind of shape my mind in regards to the sales side of the business, also the investment side of the business. So I'm excited to share a lot of this with you tonight. So to start off, I know we have hundreds of people on this right now, so I want to again thank everybody for tuning in. Some of you know me, some of you don't know me. So for those of you that don't know me, this is me. This is me, Kyle Kovats. I am the person who runs Kovats Multi-Family. What we basically do is, we invest in apartment complexes, mostly in Texas. We also have a complex in Arizona as well. I'm a general partner in 939 apartments in between both Texas and Arizona. I'm the owner of Kovats Real Estate School in New Jersey. We're a pre-licensed school in New Jersey. In 2016, I was named to the National Association of Realtors 30 Under 30. And, that's just a little bit on me. And, I'm in real estate my entire life. So I got involved in real estate in college, doing rentals in Hoboken, and then from there graduated into sales, then graduated into doing investment properties, so on and so forth. But enough about me. The reason why we're here tonight is to go over the stats and data, in a very interesting time in the real estate business where things are very dynamic, things are changing every day. So let's get right into that. Let's, stop wasting time and get right into that here. So the first thing I want to start off with here is recalibrating seller expectations. I know a lot of the people on this call right now, you are real estate agents, you are real estate brokers, you're dealing with clients, right? The thing that we're probably struggling with the most as agents, I would say, is trying to, get sellers' expectations back in check. We know that over the past, let's say 5-6 months or so, rates went up really fast. Now they're starting to level out. They're definitely starting to level out. The rates really shot up because, the forward guidance from the Fed was that, they were going to raise rates. So that got kind of baked into the markets, and, mortgage interest rates kind of followed suit. Now, if you look at this actually just came out from Goldman Sachs today. I literally just added this slide, probably about an hour ago because they just put this out today. But the median monthly payment on a 30-year mortgage right now is up 56% year over year. 56% year over year. Now, despite this, I actually put 54. That's a mistake. It should say 56. So despite this, prices are still going up. So how are prices going up while all this is going up? And there's starting to be some leveling out in the market as far as prices. But when I say leveling out, that does not mean prices are going backwards and dropping. It just means, the rate of appreciation of, let's say, 20% year over year, that's starting to slow down. But the reason why prices aren't going negative is we're going to see later, as I kind of keep going through these charts here, is the demographic story. The demographic story that's been ignored by far too many people. I don't know how many people realize this, but we have the most 28 to 34-year-olds between 2020 and 2024 of any time in United States history. Well, guess what peak home buying age is? It's between 28 and 34, with the most common age buying homes being around like 31, 32 years old. Well, you'll see in a little bit, what the most common age is of, the number one most common age of people in the country is right now. So first and foremost, again, prices, while they are still going up, they're starting to level out. It's not, the case where I know a lot of you who are probably realtors, you might be putting houses on the market, and maybe this same house you're putting on the market today, if you listed it back in January, you would have gotten, who knows, 20 offers. Now you might be getting 5 offers. Well, why is that? Because people, they're getting a little bit of, priced out of the market. And what it's resulting in for a lot of them is them turning to renting. And you're going to see in a little bit, what has happened to the rental market, because that's gone bonkers, because the people who are sitting out, they still need housing. And what are they doing? They're renting. So you have, all-time high demand, all-time low supply on both the for sale and rental side. And it's, in turn, shot prices up. And if you look at this here, this is purchase application data, right? Right now, our purchase applications nationwide for mortgages, purchase application data is the same as it was in 2009. Now, this scares some people when they look at this. They say, oh my God, purchase application data, same as 2009. That was a really horrible market. There's a big difference between now and 2009, though. Leading up to 2008, the great financial, the global financial crisis, we were really, really overbuilt. Not only were we overbuilt, oversupplied, we had a demographic dip as far as the amount of people at peak home buying age. I'll show you that in a little bit. And on top of that, there was a lot of funny money floating around. Look at how many people were applying for mortgages leading up to 2008. Really 2005 is when it started getting bad, and then really, really got bad, once we got closer to 2008, right? So with that being said, there was funny money. There was bad demographics as far as like the amount of people at peak home buying age. And then also on top of all of this, we were overbuilt, and you'll see how much we were overbuilt. We don't have that right now. Right now, the average credit score for somebody borrowing to buy a home is 776. That's number one. Number two, people have a lot of equity in their homes built up. And number three, we're really undersupplied. You'll see post 2008, we built significantly less, and that really hurt the supply side of the equation. And it's estimated right now that nationwide, we're short about 5.5 million housing units. So we're short housing units, all-time high demand, all-time lows, near all-time low supply of homes for sale. So you'll see what we mean by that in a little bit. But here's another thing to keep in mind right here when we talk about, kind of recalibrating your sellers, expectations. Look at the numbers back here. So December of 2021, it was hovering around like 33%. One out of every three homes that hit the market was immediately going under contract. Now, when they talk about immediate sales through Altos research, these are like your bidding wars. These are your multiple bids. These are homes that are going under contract in the first week that they're on the market. So these are, more than likely are multiple bid situations. Well, look at what has happened once interest rates have gone up and some buyers bowed out of the market. Now, it's still high, 23%, still higher than normal, higher than, all-time average, but now it's only 23% of all new listings are going under contract immediately. So you're seeing this right before our eyes. Altos Research, run by Mike Simonson, they put out tremendous data. I definitely recommend subscribing to him on YouTube. I'll put all my top sources at the end of this, who I kind of get all my data from. But he puts out a weekly video every single Monday going over these stats. You could see the market shifting before your eyes, right? So again, there still is buyers, there still is bidding wars, but not as many as there was. That was probably the peak of demand, because here, December 2021, we had really low interest rates, near all-time low interest rates, and on top of that, low supply, right? So that drove this number up here. So one of those things to show people that, look, and your local market, you could probably, Altos, and let me just say this, I don't get paid by them to say this stuff or anything. I'm not paid by anybody to give this tonight, so I'm just shooting you guys straight here. But Altos, they have really good data for like local markets too. They can give you local market reports like this as well. But anyway, this shows you nationwide what it's looking like. Furthermore, they also put out, data regarding price reductions. So what is the percentage of property that have had price reductions? Well, right now, again, it's still near all-time lows. Only about 23% of homes right now, are seeing price reductions. But with that being said, look how rapidly that's rising. Last May, only 15% of homes were having price reductions. Right now, this is as of the end of May here, 23.1% of homes having price reductions. So, what's normal is usually about like one out of every three homes will have a price reduction before it sells. Right now, again, still lower than historical norms here. But with that being said, despite the fact that we are still lower than historical norms, it is rising. It's something to keep an eye on. So be forward looking as far as, when you list your clients' homes, right? You don't want to just, be over ambitious and, try to stretch the market. Stretching the market right now is not going to work out. Make sure you price the house right, you price it right, you're probably going to get multiple bids and, again, jack that price up. And here's the inventory, kind of tracking the inventory. It is starting to climb. Last year at this time, we had about 327,000 homes in the market. This week, about 365,000 homes in the market. So, inventory is climbing. Again, we're still way, way, way below all-time lows. According to the National Association of Realtors, we're at about 2.2 months, inventory. And typically, what we need to see is about 6 months worth of inventory to have a balanced market, they say. And by balanced market, that means, normal historical appreciation of like 2.5%, 3% a year. So when we have this amount of super low inventory, we have an all-time high amount of people hitting, peak home buying age and household formation age. I mean, it's really a recipe for just, you know, a real estate market that's on fire. And we're seeing that, right? And here's another thing that's going to keep supply low. Right now, here's some stats for you that, I mean, are truly mind-boggling if you think of them. 9 out of 10 homes that have mortgages in the US, they have an interest rate of less than 5%. This is how it breaks down here. Now, furthermore, look at this bullet point 3 here. More than 40% of all homeowners, they don't even have a mortgage at all. So this is coined the lock-in effect. What the lock-in effect means is that if your interest rate is lower than the current prevailing interest rate and prices are higher, those people typically historically don't sell unless they really, really are forced to sell. And people aren't forced to sell. We have all-time low delinquency rates in the country right now on mortgages, all-time low delinquency rates, bankruptcies, you know, things like that. So we have all-time low delinquencies. We have people who have locked in super, super cheap debt. And again, on top of all of this, 40% of all homeowners have no mortgages. So why would these people sell? The thing is, we're not seeing them sell. We're not seeing them sell. We're seeing people stay in their houses longer. Right now, on average nationwide, it's estimated that people are staying in their homes on average for about 11 to 13 years. In the early 2000s, that number was 7 years. People are staying in their homes longer, and what are they doing when they have these low interest rates and these really low monthly payments locked in? Rather than move and be a move-up buyer, they're renovating instead. They're putting some additions on instead. This is going to keep inventory super low. Now, the thing is, if interest rates, I shouldn't say if, I should say when interest rates do dip back down, when that occurs, these people might consider selling. But as we know, when interest rates go back down, what happens? Debt becomes cheaper. Borrowers can borrow more. They can buy more. They can afford to pay more. And what's going to happen there? Both sides of the equation, prices go up, right? So this is, you know, what we call the lock-in effect. Again, these numbers, 9 out of 10 people that have homes, that own homes that have, you know, mortgages on them, their rate is below 5%. 40% of all homeowners don't even have a mortgage. There's no reason for those people to sell. And this chart here, this chart on the screen right here, this talks about existing inventory, you know, of existing homes for sale. We have to get up to roughly about 2.9 million homes for sale to hit 6-month inventory. Now, this chart is from the beginning of the year. There was about 950,000 homes in the market. National Association of Realtors put out the report this week. We have 1,030,000 homes on the market. I put it in bullet point 2 here, which equates to about 2.2 months worth of inventory. So we're still well below this. We're still near, you know, all-time lows as far as inventory is concerned. And, you know, when these lines match up, the light blue line, which is active inventory, and the dark blue line, which is what you have to hit to get 6 months inventory, you know, that's when we have a balanced market. That's when you would have a balanced market. When the light blue line goes over the dark blue line of, you know, how much inventory versus 6 months inventory, that's when you have down markets. And you can see this directly coincide, right? When did the market really start dropping? You know, the lead up to this started around 2005, right? And you see this happening 2005, 2006. From 2006 until about 2012, you know, peak versus trough, right? That was not a great real estate market. It directly coincides with this. So as long as inventory stays low, it's super hard to make a case that prices are going to go negative. And I've had some people tell me, well, what happens if interest rates go up then? Well, here's the thing. If interest rates go up, then you're telling me the economy's on fire, right? Because you're going to see in a little bit, I'll show you a chart that shows you historically what happens to interest rates when the economy hits a recession. So you have to be on one side of the table. You're either interest rates are high and the economy's on fire, or interest rates are low and the economy's, you know, not so good. And that seems to be the way that we're trending, right? Global forecasts for GDP, you know, got lowered this week, you know, and that usually is a good indication that there's, you know, some kind of recession coming up. But with that being said, if there is a recession, we'll talk about how I think that will affect the real estate market, and you'll see, you know, my, you know, I guess insights and charts that I've gathered on that here. So this is another chart just showing, you know, the National Association of Realtors inventory. One thing I do want to point out, because you're going to see me sometimes put Altos research inventory, like for instance on this slide here, which shows about 364,000 homes. Altos considers active inventory homes that are literally actively available, like homes that are for sale. Whereas National Association of Realtors, when they say there's, you know, 1,030,000 units, that is homes that are active and also under contract. They've accepted an offer. So I do want to point that out. But you can see here, right, historically where inventory levels have been all the way back to, 1982. Seems to hover around like 2 million, right? Typically in that range. Right now, we're about half of that. So again, for us to get to a normal market where we're seeing just, kind of standard historical appreciation of like 2.5%, 3% a year, we'd have to get up to about, close to 6 months, supply. And we're not even close to that right now. And again, granted, this article's about a year old, but the same holds true. We're about 5.5 million homes short, on the supply side, nationwide. And the thing is, to stay neutral, when I say stay neutral, stay neutral means to stay at 5.5 million housing units short. We have to complete 1.5 million housing units a year, and we're not doing that. There's permitted homes, there's homes that have received permits to build, but as far as what we're actually completing, you'll see charts that say like home starts versus home completions. Home starts could just mean they got a permit issued, that they're approved to build. That doesn't mean there's a shovel in the ground. Completed is what is important to look at. How many homes are we actually building? And right now we're building about, completing about 1.4 million homes, somewhere between 1.2 and 1.4. So this gap is getting even worse as far as like how short we are on the inventory side. And the problem is, this doesn't look like it's getting solved anytime soon. Here's why. Look at these stats on the left side. 9% right now of all construction workers are age 25 or younger. That is the lowest percentage of all time. So the thing is, in order to create more houses, people have to build more houses. And if the younger generation is not going into this line of work, who the hell is going to build the houses? So one of two things has to happen here. You need more people to build. And if more people are not building, how do they attract more people to go into this trade? They have to pay more. So you're either going to have a shortage of labor, which you pay more, or you're going to have a situation where there's a shortage of labor and they don't pay more and they build less. Either situation results in even more, huge lacks of supply. So the government probably needs to roll out some really serious programs as far as like real tax incentives for builders to build. I'm talking like tax incentives that, politically might not be popular because, builders will get enormous tax breaks. And, for the current administration, it's not exactly palatable, for them to do so. But, we'll see what ultimately happens, after November and then in 2024 if things do change. So, and then last but not least here, 25% of all construction workers, they're age 55 or older. Now, construction is a physical job. Your body wears down, right? And when your body wears down, you can't swing a hammer at age 60 like you swung a hammer at age 25, right? So with that being said, when these people start retiring, they're a good chunk of the construction workforce. And these people, there's not enough of them 25 and younger to replace them. I mean, that gap's going to be really, it's going to become a huge issue. So, we need a lot more net migration coming to the US because number one, people are having less kids right now. Number two, we need blue collar workers. So, our government needs to get serious about really, looking into revamping the immigration system and, getting it under control, number one. And number two, legally bringing in people who are willing to do this type of work because we have a really big problem on our hands there. And, it's a problem as far as like the shortage of housing. Now, if you're a real estate investor, shortage of housing is something that you're like, wow, this is, we're going to do really well. But for the nation as a whole, not so great, because prices are going to go up. So again, this is the completions, right? Homes that are actually being completed. Look, leading up to 2008, the 2008 financial crisis, right? We were really overbuilding. Look, we got to a certain point where we were building over 2.2 million housing units a year, close to 2.3. Then the market crashed, and look what happened. Builders stopped building. We got to as low, if you look here in 2010, 2011, we got to like 500,000 homes being built per year. That's super low. Now, it's gone up over the years, but right now we're hovering between about 1.2 and 1.4 million housing units being built per year. And again, we got to build 1.5 million housing units a year just to stay at 5.5 million short. And we can't even do that. So to start eating into this 5.5 million, to give you guys an example, if we built 2 million housing units in a single year, that shortage would go from 5.5 million to 5 million. And look, I mean, there's only one time ever we've really built that much here. So, and how do we come up with that 1.5 million number? It's estimated we need to build 1.2 million homes a year. And then there's 300,000 homes a year that get retired, as we say. Retired means knocked down, uninhabitable. So that's why we have to build that many homes a year, just to stay neutral. And then this here is the monthly. This is a chart I just wanted to throw up here because I saw this floating around online and people I think were freaking out looking at this. This is the monthly supply of new homes for sale in the US. So when you look at this, it says 9 months. But again, this here, of this 9 months worth of inventory for new homes, this is a direct quote from Logan Monashami. He's a lead analyst at Housing Wire. If you don't have a Housing Wire subscription, I highly recommend subscribing to them. Tremendous content they put out. I get a lot of my, kind of insights from them. But Logan explained this, and what he said is that this supply spike, it's not the supply spike that we had from 2005 to 2008. Of this supply that you're seeing here, 6 months of the supply is homes that haven't even started building. They don't even have a shovel in the ground. And only about 1 month of this 9 months worth of product is actually homes available. So this chart's a little bit misleading here. So if you see somebody throw this chart out there at you and they're like, well, look at the, jump in months of supply. Well, you should say back to them, look at, where is it? I have it, right? So the chart, and this kind of gets into it. Look at this chart, right? We're at 2.2 months worth of inventory. So again, this here, this is, a chart that would be thrown out to you by like fear mongers. There's people who like they salivate and they love to say the market's going to drop, the market's going to drop. And they could be right once, every 25 years, because if you say the same shit every single day, I mean, you're bound to be right once. But right now is not the time they're going to be right. I'll tell you that. And this is direct quote from Logan, right? And a chart. It's a really good chart, but I wanted to, kind of credit this directly to him. But he showed, how, 2008 was so different than now, because look at what happened leading up to 2008. This chart measures bankruptcies and foreclosures. The red line is bankruptcies, the blue chart is foreclosures, right? So look at this. Started in 2005, led up to about 2008, peaked around, 2010, 11-ish, and then started, trending back downwards. But what you had here was, again, a lot of funny money. A lot of funny money, meaning that people were breathing on mirrors and getting loans to buy homes. We don't have that anymore. The average credit score of somebody buying a home today, 776, number one. Number two, we have all-time low delinquency rates. So it's all a supply side story, right? The reason why the market did so bad, and as far as housing is concerned, during the 2008 financial crisis, is because people were forced to sell. There was forced selling. There was foreclosures. We don't have that situation right now. We have all-time low, literally, factually. This is not me saying it like, hyperbolically. It's a fact. We have all-time low delinquency rates right now. There is going to be no forced credit selling. There was people who 6 months ago thought, what about forbearance? What about foreclosures? It's just not true. Just, never happened, never came to fruition. It was more or less, it's one of those things that people just kind of threw out there because they're like, I can't believe this. Well, the thing is, a lot of people just didn't know the demographics. And, we'll go over the demographics in a little bit. But again, 2006, 2011, we had really bad demographics as far as, the people at peak home buying age, dip in population there. And then also, you had funny money. We were overbuilt. You had forced credit selling. Again, look at the difference here between leading up to 2008 and now. All-time low delinquency. Here's another chart. Household debt to cash. For the first time in 30 years, our net household debt in this country is negative. What does that mean? That means net cash exceeds total debt of households on average. This is the first time in 30 years. People's balance sheets are as healthy as they've ever been. This is from April 20th, 2022. So not much has changed over the past, month or so. But again, this is the first time in 30 years where net debt has been negative in this country, where on average cash exceeds total debt. And you'll see why, because when the pandemic started, people saved up so much money. One of the charts we're going to go over in a little bit is how the savings rate has gone down. But with that being said, despite the savings rate going down, people saved up so much money. People saved up about $2.2-ish trillion, trillion with a T, $trillion. So they're still saving money and haven't even tapped that yet. So we'll talk about that. So here's the chart. Mortgage origination by credit scores. Look at this. Look at 2005 to 2008, the financial crisis here. Look at the credit scores. Funny money, right? Look here. This light blue is people who have credit scores of 760 plus. This dark gray, 720 to 759. This light gray, still not that bad, 660 to 719. And then down here, these are the low credit scores. Look at the difference here. Big difference. And again, the median credit score of a newly originated mortgage is 776, which is just below the all-time high. The all-time high was the month prior at 788. So these aren't like fugazi buyers. These are real buyers who are financially qualified. So again, this has led to us having the lowest delinquency rates of all time, right? This is from Black Knight. Black Knight puts out really good data as well. So again, in April, the delinquency rate nationally was 2.8. This is the lowest of all time. Lowest of all time. So again, we're not going to have forced credit selling. People are extremely healthy. Here's another chart. There's a chart I didn't put in these slides, but I'll just put it out there to you. Right now, there's about 38 trillion worth of real estate in this country. There's only 12 trillion of that in debt, which means 26 trillion of that 38 trillion is equity, which means that basically the average loan to value ratio on a home is only 30%, which means on average homes have about 70% equity in them. I'm telling you, people are in extremely healthy positions. Now, obviously, it's tough to buy right now. If you're trying to buy right now, it's tough, right? But as far as the people who own homes, they're as healthy as they've ever been. And here's another chart that kind of shows you, where we're at. And what this chart measures is, the average mortgage payment, divided by your average weekly earnings. And look where we're at. We're still pretty close. We're not at all-time lows, but we're still pretty damn healthy here, right? So again, this measures, your mortgage payment compared to your earnings. We're still pretty damn low. Look at where it's been. This goes back to like the mid 80s. We're below pretty much every single year, except for 2012, 2015, 16. Again, people are in really good shape. Incomes have gone up. When you have 11 million open jobs, the way that employers attract employees is by doing what? Paying more money. So wages have really gone up. So where the hell are these buyers coming from? Anybody know who this is? This is, famously Bad Luck Brian, right? Bad Luck Brian, I remember seeing this years ago as a funny meme on the internet. Well, Bad Luck Brian was born in 1989. He is your buyer today. This is Bad Luck Brian today. This is what he looks like today, wearing the same outfit. So he is your standard buyer today. So now we're going to get into demographics, because this is the story that a lot of people aren't following and they should be following, because demographics tell the whole story of everything. So despite the fact prices are going up, rates are going up, why are they still going up? Prices are going up simply because life happened. Because here's the thing, like the Wall Street people can't understand this. They can't understand, prices are up. Wouldn't people just sell? No, because guess what? You have a family, you have a spouse, you have kids. You don't just come home one day and say, good time to sell. Let's get you out of school. Let's move you all over the place because we want to take advantage of making a couple $100,000. People don't do that. People live lives. People are humans. They need shelter, right? So again, take a look at this. Millennials are the largest generation in US history. Look at this spike here. So right now, this spike, ages like 28 to 34, most amount of people in the country. Guess what peak home buying age is? Right here. This is what has led to this unprecedented amount of demand in housing. It's just as simple as life happened. Because, to quote Logan Monashami, and you're gonna hear me say his name 100 different times, he says this, and which I find to be true, right? People date, people mate, people get married. On average, 3.5 years after marriage, they have kids. And somewhere in between the whole marriage and kids thing, they buy a house. That happens to be around this age. There's the most amount of people around this age. See this dip here? These people in this area, they were at peak home buying age in 2008. 2008 were when we were overbuilt, when we had funny money. 2008 when, on top of all of that, we had a dip in demographics. We had all-time, really high supply. So again, That was like the worst. That was like a storm, like a 100-year storm, right? Well, this is a 100-year storm for the good. This was a 100-year storm for the bad. So again, it's as simple as life. Life happens, right? When life happens, you buy a house. Now, with that being said, some of these people are getting priced out. They truly are getting priced out. Because again, as we saw, monthly mortgage payments up 56% year over year. When they get priced out, they still need a house. What are they doing? They're renting. And that's why rents have skyrocketed too. Rents are going to continue to go high. We'll talk about that in a little bit. So this is breaking down the population by, 5-year cohorts. So 2021, the most common 5-year cohort is people ages 30 to 34. The second, 25 to 29. The third, 35 to 39. So these people in here, the top two, those are the most likely people to buy homes. Look at this catastrophe back in 2010 around the great financial crisis. The most common ages were 45 to 49, not peak home buying age. 50 to 54, not peak home buying age. This age, more downsizing age. 15 to 19, they're not even adults yet. 20 to 24, not adults yet, right? So this was like a tsunami. Really bad stuff back then. This year, this is like a rainbow with 70 degrees and sunny. And look where it goes in 2030. Still not bad. But take a look at this. Look at this. This breaks down the population by age. The 3 biggest cohorts for ages 30 to 34, 25 to 29, 20 to 24. When these people get into the 35, 39 bracket, then the biggest group of people comes into 30, 34. And who follows them up? The third biggest group of people. Gen Z is pretty damn big themselves too, population-wise. So we're in for a really good story demographically. The other thing too is that builders, they're not willing to even take a risk of taking a bath like they did in 2008 and overbuilding. So right now their margins are super high and they're comfortable keeping supply low. They don't want to overbuild. So they're starting to tap the brakes on building because they want to keep their margins high. The problem with that, materials are going higher, labor costs are going higher, interest rates are going higher. When they slow down on building, all that does is just make the supply issue even, bigger. Again, we're already 5.5 million housing units short. Odds are that it's probably going to get a little bit bigger. And this is the most common age by year. So in 2021, the most common age was 31. Second was age 30. Third was age 29. Fourth, age 32. Fifth, age 28. Sixth, age 33. Look at this here. This is peak home buying age. The most amount of people alive in 2021, age 31. The most amount of people alive, followed up by age 30, 29, 32, 28, 33. These people are all peak home buying age. They're the biggest group of people in the whole country. They're all hitting peak home buying age. They're all doing well as far as incomes are concerned because wages have gone up. And on top of this, again, we have a situation where we have really, really low supply. Really low supply. Take a look at this. So again, we have all-time high demand, all-time low supply. It's really that simple. Sometimes people try to overcomplicate things. It's really that simple. And again, just to quote Logan here, I said this before, why do people buy? People date, they mate, they get married. 3.5 years after marriage, they have kids. And again, as he says, people don't decide to buy. Your life decides when you buy. You need shelter. You don't just say like, you know what? I got a nice little studio apartment. I'll raise my family here. You don't do that. Again, you get married, you have kids, you buy a house. So again, this is the most common age to do so. And these people, they're all hitting at once. And now we get into like rental housing here, right? So as far as rental housing is concerned, what does that outlook look like? Well, when people decide to sit out the purchase market, they rent. And over the past 3 decades, we've built about 5 million new apartments. The problem is we've had a lot more renters than 5 million, come about in the past 3 decades. So this has led to total vacancies, all the way down to about 2.4%. 2.4%. Now, some other sources will say closer to like 5%, but those sources will still say they're 5% like all-time low. But bottom line, we have all-time low vacancy rates. All-time low vacancy rates while we have an all-time high demand. All-time low supply. On top of this all-time high demand, what does that equal? That equals higher prices. Again, it's really that simple. Now, one of the things that I would tell you, if you're working with buyers who are like, prices are getting crazy, I'm going to sit this one out, I'm going to rent for a little bit and then come back in. One of the things I would tell them is, look, if you rents are up about 20% year over year right now. They're not really showing, signs of slowing down that much. Now, if they slow down, is slow down like 20% year over year rent growth to 10%? That's still high. So why not buy, fix in your mortgage payment? Obviously, your property taxes could change and insurance could change, but your principal and interest stays the same, right? You're fixing that in. And maybe you're like, but I have to get, a 5.2, 5.3, 30-year fixed rate. Do it. Then when rates come down, just refi. You don't have to stay at 5.2, 5.3 forever. What I'm about to say is a guess, but my guesstimate is I think rates come down sooner than most people think. I think rates probably start coming down in 15, 18 months. Some people actually think sooner because with the, inflation beginning to ease up a little bit and some negative global growth data, they think that the Fed's going to have to, tap the brakes sooner than most people think and, how they're talking. But again, the case to buy is lock in your monthly payment because if you're renting, your rent's going to keep going up because we have all-time low supply, all-time high demand. We have the most amount of people ever hitting peak home buying age. Take a look at this. Supply and demand. What happened when vacancy went down? Rents went up. They almost mirrored one another. Now, here they didn't. I'm trying to figure out why, but they pretty much, for the most part, mirrored one another. When vacancy went down, rents went up. So again, I'll show you in a little bit. Q1, I believe it's Q1 2022. I'll show you in the chart. We had all-time high demand for rental housing. And again, that doesn't look like it's slowing down because when people get skittish on buying, they go rent. And when they go rent, rents are skyrocketing. And Jay Parsons, he's a rental housing economist. He's a great follow on social media, as well as, all the, content that he puts out. But he tracks some different things too. One of the things that he tracks are retention ratios. So renters are realizing that, I need to renew my lease because here's the thing. If I don't renew my lease and I move to a new apartment complex and I rent something new, the rent's going to be a lot higher because renewal rates, let's say, your renewal rate on your apartment might be, let's say 1,100. But if you rented it and we're a new tenant in there, they're renting to the new tenants at 1,200. So people are renewing. They're renewing near all-time high rates, or excuse me, at all-time high rates, close to 65% here. And this is for C-class properties here in particular. But again, they're realizing this. And here's the thing: you can't renew unless you're paying your rent on time. So people are paying the rent on time and renewing. So again, that's what Jay gets into and talks about here in particular. So there's no crazy eviction backlog, that's kind of, gotten through the system, with the eviction moratorium and things like that. We've had some time to kind of get through that. Some courts might still be backed up depending upon where you are, but for the most part, everything's kind of back to normal at this point. And Jay put this this out on Monday, and it was the May rental report, nationwide, and May rent year over year went up 19.5%. That's a new record. That's a new all-time high. So again, why is that? Because if you were wondering, when you took a listing in January, you're a real estate agent and you had 20 offers, and that same similar listing now has 5 offers, 6 offers, 7 offers, and you're thinking, where'd these buyers go? They didn't disappear. They're choosing instead to rent because they have this in their mind that there's uncertainty in the market. I think the market might come down. The thing is, most people don't follow what I'm showing you here. I just get obsessive over this stuff. I follow this stuff because I want to be, at least try, to be ahead in the sense of, being able to somewhat have at least an educated guess on what might happen. But again, these people aren't disappearing. They're opting to rent. And when they're opting to rent, you're seeing bidding wars on rentals now. I mean, I know, for instance, I've had rentals recently as both an agent and as an investor where we've had, multiple bids, on them, right? So anyway, bottom line, rent year over year is growing at an all-time high rate, 19.5%. Now, that's going to come down, obviously. That's not going to stay that high. That's insane how high that is. Typical, is like 3% a year. 19.5 is insane. And take a look at this. If your rent went up 19.5% year over year, it doesn't look too bad when you look at this. Here's the change in monthly mortgage payment for people across the country in major markets. Las Vegas, Tampa, and Raleigh, 40% change. This is just from 6 months ago. So at the end, in December 2021 in Las Vegas, as an example, the average monthly payment was $1,355, and that's just principal and interest, doesn't include taxes and insurance here. And again, what they base this off is, again, 20% down, right? So you see at the bottom here. Now their monthly payment is what? $1,894. Their monthly payment, and this is just principal and interest, has gone up 40%. Forget tax and insurance, right? So look at all these different major markets. Anywhere between 33 to 40% monthly payment has gone up on their mortgage. So when you see a 19% rent growth, or buying and it costing 40% more, 19 don't look so bad anymore. So again, this is, if you're wondering how people are still renting for that, well, because you have the greatest amount of people ever trying to rent places, trying to buy places, all while we have a shortage. We have a shortage on the rental side and the sale side, right? And here's the thing, renters, they got room to run. Renters are making more and more money. Renters are at historical highs as far as income is concerned. Look at the gap here between renters' income, the asking rent, and what they're actually paying. So in-place rents is what units are currently rented for. Look at the gap between in-place rents versus renters' incomes. Big gap there. Even between asking rent and renters' income, we have a good gap there too. So again, the thing is, tenants still have more money to pay. As far as like keeping things, if these two matched, really, it'd be, that's what they could afford. They could afford more here. Take a look at this. So this apartment renters' incomes. Look, so this orange dotted line is Class A properties, which is like more luxury style, newer property. This purple dotted line is Class B, and this green dotted line is Class C. Now, Class C's incomes have stayed somewhat flat, right? So they've gone from about 40,000 to about, 45,000. Look where Class A has gone, from the beginning of COVID, right? Here, they're about 75,000. Now, about 100,000. So it shouldn't shock you that Class A is seeing the highest rent growth. Unfortunately for the people in Class C properties making, 40 to 45,000, they're affected the most by inflation. Inflation really hurts them because they're already, having a tough time getting by. So that's why you're seeing rent growth be the lowest in Class C and the highest in Class A, because Class A can absorb it. They're making more money. A lot of these people are renters by choice. They could buy very easily, but they're renters by choice. So, and that does seem to be a little bit more of a trend. So, any of you who and I know there's a lot of you on here who invested with us on our prior deals. You've noticed that over the past year, we've been moving more towards Class A as we've seen the inflation data pick up, and the data pick up as far as like what the rent growth is in Class A versus Class C. This is why we focus more on, Class A properties and Class A locations, Class, B, Class A, but mostly we lean more towards Class A and, really good locations now because of these numbers here, right? Good room to run. And again, this is April's rent growth, just to show you. I just told you in May's numbers just came out this week. Year over year was up 19.5% nationwide. In April was just below that, around 19%. So rent is growing because again, we have the most amount of people ever looking for housing, whether it be sale housing or rental housing, hitting peak, household formation age. So it should be no secret when you have an undersupply and just all-time high demand. Again, it's really as simple as supply and demand. So check this out. They don't have the Q2 numbers for apartment demand, but Q1 2022, all-time high demand for apartments, all-time high demand. And again, this isn't a secret. It shouldn't be a secret if you follow the demographics. Now, I say this as if everybody should be following this, but I should say it to myself because as of 6 months ago, I didn't follow that shit either. So the thing is, this is probably new to a lot of people. I know it was new to me 6 months ago, but after I saw this, I was like, oh my God, how did I never pay attention to this? Because it's something that you don't really see out there too often. But once you pay attention to demographics, these things start making a lot more sense. Because I remember the beginning of COVID, right? I'm doing brokerage activity in Jersey as well. And I'm like, where the heck are all these buyers coming from? And I was thinking, maybe they're coming from the city. Maybe they're coming from Hoboken, Jersey City. I work in North Jersey. And then, once I learned about the demographics, it finally hit me. They didn't all just come from the city. They didn't all just come from Hoboken, Jersey City, Weehawken, West New York, Edgewater. They came from their mother. That's where they came from. They were literally born. They were just breathing. They just happened to hit the age where it was time to buy a house. It was really that simple. Now, I didn't realize that because I never paid attention really too closely to the demographics prior to that. But after learning about the demographics, this stuff made a lot more sense. And where are they moving to? So this was put out by on a Housing Wire Plus webinar, specifically by Odetta Cushy. You'll see me source her at the end. But the 3 cities that the most people are moving to, Seattle, Washington, #1, which that actually really surprised me. Now, granted, I don't know much about Seattle at all, but the most amount of net migration nationwide is happening in Seattle, about 62,000. Second is Dallas, 59,000. Third is Houston, about 58,000. The cities where the most people are moving out of, New York City, they lost 220,000 people net. Los Angeles, 103,000. And this one shocked me. Miami, lost 64,000. I guess the people from Miami moved north, maybe into this area, or it could be the New York people moved here. But also, obviously, Jersey benefited from people moving out of, New York as well here. But as most of you know, the markets that I look in, to buy is Dallas and Houston. So this is comforting for me to see that, kind of our investment thesis kind of, is playing out properly as far as like population growth, wage growth, economic growth, good diversity of employment and stuff like that. And really the areas that are, seeing the biggest benefits are what we call the exurbs. Those are the areas right outside of, not right outside, but outside of urban communities that are more suburban, but still have walkability. Because millennials love walkability. And I think everybody likes walkability, right? Being able to walk places, being able to walk to the supermarket, to the pharmacy, to coffee shops, to bars, to restaurants, places of entertainment, parks, things like that. So, those are areas that we typically look in. And, my top 3 markets personally, obviously the 2 that I look in, Dallas and Houston. If I were to name a third, it would be Greenville, South Carolina. I think Greenville, South Carolina is, I've been saying this for years. I'm like, Greenville, South Carolina is going to pop. It's definitely has already started to pop, but there's so much growth left there in Greenville and the surrounding areas there. It's about an hour south of Charlotte, but it is an awesome, awesome area. So any of you up in the Northeast, if you and your family want to take like a, really cool, kind of long weekend trip, go to Greenville, South Carolina. I promise you, you will walk away and you'll probably send me an email saying, oh my God, thank you. How the heck did you find this place? Because it really is a hidden gem. It's unbelievable. So probably never heard of it, but Greenville, South Carolina. So anyway, here's my view on apartments, right? So there's 2 things that could happen, right? As far as like investment properties. Right now, here's what we're seeing. Number 1, interest rates are going up. We have really low supply. We have the largest demographic ever in U.S. history entering, peak home buying age and household formation age. Now, what is that, equaled? That has created that not everybody can get a house. So when you can't get a house, those people decide, well, I can't get a home to buy, so I'm going to rent. So we have a historic number of renters. And again, that's why we have all-time high, rental housing demand. And what you're seeing is all-time high rent growth year over year. Again, May showed 19.5%. Now, what happens when rates go down? Well, when rates go down, debt gets cheaper. So maybe some of those renters can now afford more. But when they can afford more, a lot more people can afford more. And when that happens, the real estate prices are going to go up and the asset values are going to appreciate higher. And when that happens, it might be time to sell and reap the benefits. During phase number 1, you benefit from the cash flow of owning investment properties because rent's going up super high. Number 2, we're still undersupplied, so rent's still going to go up. But on top of that, now the debt's gotten cheaper. So people can pay more for properties and then you could sell and reap the benefit. So in both situations, the beauty of rental property is that when you hold it, your tenants pay your mortgage, right? Your tenants pay your mortgage. And when they pay that, you're cash flowing positively. You collect passive income. Then when you sell, you reap the benefits of a big capital event, right? When the property sells. And then you hopefully reinvest that money and, effectively, and you get additional tax deductions and things like that from like depreciation. help offset those gains, maybe do a 1031 exchange, whatever you might do. So, I'm just putting this in here. We have a lot more slides to get through. So, we're definitely net buyers in this market. A lot of you have invested with us, but if anybody wants to be added to, our investor list, we could certainly put you on there. We look to buy apartment complexes in Houston and Dallas. We typically look for deals that'll do like anywhere between 16 to 18% average annualized return, and somewhere between 6 to 7% cash flow, during the hold. And then obviously we do like things like cost segregation studies. So on average on our deals, it's been about for $100,000 investment, you get about a $75,000 tax deduction, that we distribute out to investors through K1s and things like that. So anyway, if you want to be added to our investor list, I can't promise you I can get you in deals because our deals do fill up, relatively quickly, but I could try my best to get you in. So feel free to email me. My email is on the screen, and then just write in the subject line like add me to your investor database. I'd be happy to do that. So anyway, with that being said, let's move on here. So let's get into interest rates here. So as far as interest rates are concerned, I think there was a lot of people who were freaking out and worrying like, oh my God, rates are going up. They're going to hit 8%, 9%, 10%. They're going to keep going up higher and higher and higher. Here's the thing. If your case is that interest rates keep going up, your case also has to be the economy is going to be on fire. And, we're starting to see some negative data as far as the economy is concerned, at least, how the government measures the economy, right? As far as like global growth and GDP and things of that sort. So with that being said, if the global growth numbers and GDP numbers begin to kind of slow down, the case for them continuing to raise rates, you're going to have a tough time making that case. I'm going to show you why in a little bit, in regards to where rates typically go, in regards to, when we get into recessionary times. But this is from Bill McBride. Bill McBride, he runs a great Substack called Calculated Risk. I definitely recommend subscribing to it. But this was something that he put out there. And based on current estimates, the peak for Fed funds rate is 3.25 to 4%. Now, with that being said, the Fed always talks about we want to get to neutral, want to get to neutral, want to get to neutral. The problem is nobody knows what neutral is. Is neutral 2.5? Is neutral 3%? Nobody really knows what neutral happens to be. I think, again, this is just my opinion. From all the people I've read, all the stuff that I've read, and all the people I kind of trust who put out good data out there, I think it's really hard to make a case of them getting the Fed funds rate to 4%. It could happen. Again, I could be wrong. This is me just kind of spitballing here, but I think it's hard to make that case. And if they get to 4%, and then the 10-year Treasury kind of lines up neutrally with that, what you would see, let's say hypothetically that the 10-year Treasury sits at 3.25%. Historically, mortgage rates on 30-year fixed rate loans are 1.75% higher than the 10-year Treasury rate. So again, granted, the Fed funds rate and Treasury rate are two totally different things, right? So, don't conflate the two as being, similar. But a lot of this has been kind of priced in already. So when the Fed got tough and started talking about, raising rates and things like that, well, the long end, started pricing that in, right? So the 10-year Treasury shot up, right? And now the 10-year Treasury hovers around like, around like 3%. I saw this morning, I haven't checked since this morning. I saw this morning it was around like 3.06. I don't know what it is right now. It's probably still around that general vicinity. But, hypothetically, if your 10-year Treasury is at 3%, that would mean that your 30-year fixed rate mortgage is at 4.75. So right now it's higher, like the 30-year fixed rate mortgage national average is around, depending upon where you look, the numbers that are out there, I think from Freddie Mac show 5.1% or 5.09%. It's a little bigger. There's a gap there, right? Because they think it's going to go a little bit higher. But also, anytime the 10-year Treasury has come close to 3.25%, it faces enormous pushback. So if it does cross over 3.25%, a lot of people will be surprised about that. JP Morgan yesterday, I forget exactly who the gentleman was from JP Morgan, but he was on the Bloomberg Surveillance podcast, and his estimate had the 10-year Treasury kind of peaking around the 3.15% amount, which would indicate, 30-year fixed rate mortgages around 4.9%. So we're already higher than that. And we've seen mortgage interest rates starting to kind of flatten out over the past 3 weeks. In fact, the past 3 weeks leading up to the beginning of this week, I have to see if they put the data out for the end of this week yet. We saw mortgage rates coming down nationally, actually. So take a look at this chart here. It shows that the relationship between 30-year fixed rate mortgages and the 10-year treasury. So the blue line is 30-year fixed rate mortgages. The orange line is a 10-year treasury plus 1.75%. They move almost identically, except for, really just one period here. They almost move identically to one another, right? And I'll show you a chart that goes back even further in a little bit. Look at this chart. It goes back to like the mid 80s. 10-year treasury, 30-year fixed rate mortgage. They mirror one another. So historically, you could take the 10-year treasury, add 1.75% to it, and that's your mortgage rate. And here's a quote from Dr. Lawrence Yun. He's the chief economist for National Association of Realtors. He's a wealth of knowledge. He's a great guy. If you've ever been to a National Association of Realtors event and he's at them speaking, you know from experience that he's an open book. Like, he'll allow you to just walk up to him and talk to him. So he's a guy I follow closely, and he puts out some really good data, and he's, really, obviously intellectually smart as well. This is a quote from him from a podcast about a month ago. So he said, if one looks at past history, one sees that at times when the Fed aggressively raises interest rates, mortgage rates barely budge. So it is possible, in my view, that most of the mortgage rate increases have already occurred. So any further jacking up of interest rates by the Fed may not have any meaningful impact on mortgage rates. He said this right before the May Fed meeting. Guess what happened? The May Fed meeting. They obviously raised, the Fed funds rate, 50 basis points. Where'd mortgage rates go? They stayed kind of flat. And then for 3 straight weeks, they actually went down. So again, it just goes to show you that it's kind of been baked into the cake that, rate hikes were coming. And now we're starting to see mortgage rates flatten out. Now, I think they definitely probably, I shouldn't say definitely. I think they probably will go up a little bit more. But how much more, is to be determined. You have to, take into consideration that the Fed's letting, mortgage-backed securities kind of roll off their balance sheet. So we'll see how that ultimately plays out. So again, this was an article, from last week, showing you this from a week ago. I'd have to, I should see if they put another one out this week. But for 3 straight weeks, mortgage rates went down, actually. So again, we're starting to see that flatten out a little bit. So people who are trying to make the case that rates are going to keep going up, they're going to skyrocket. I see sometimes, on Facebook and on different social media platforms that, I remember seeing some guy post before the May Fed meeting that keep an eye on mortgage rates. Watch, after this meeting, rates are going to shoot right up to 6%. That's just somebody who probably should keep their mouth shut, because, it's best to just not talk about things that you don't, really know what you're talking about on, because you look foolish. So, and again, I'm not saying I'm an expert, but I usually know when not to speak versus when to speak. Some would say the opposite, but anyway, that's that. So here, higher rates and recession, right? So people who are saying we're going to have higher rates and a recession, look historically back to the 1970s, what happens every time we have a recession. These gray bars are when we had a recession. So around 1970, had a recession, rates went down. 1975, beginning of the recession, rates went a little bit up, then went down. Early 1980s recession, rates went down. 1990 recession, rates went down. Early 2000s recession, rates went down. 2008 recession, rates went down. So again, it's really tough to make a case that you're going to have a recession while rates keep going higher. If it happens, it's really hasn't happened before for the most part. So again, keep in mind that you can't really make the case we're going to have a recession and higher rates. If you're saying rates are going to keep going higher, what you are saying and what you need to also say is that the economy is going to be on fire. So again, you got to be consistent with that. And if the economy's on fire, great, right? But if you hit some kind of recession, and if we do have a recession, what kind of recession it is becomes a question. So take a look at this. So, a recession definitely is possible, right? And if not likely, and I actually wrote that. I didn't realize I wrote that. So a recession is, definitely possible, if not likely. So with that being said, what type of recession would we be looking at? I don't think it'll be that bad of a recession, because not all recessions are created equal. Not every recession is 2008. I think we're scarred as a society, as a country from 2008. We're so scarred from that we think anytime the word recession comes up, everything's 2008. Here's the thing. If it's a job loss recession, there's about 11 million jobs to be filled right now. Look at 2008 when that recession hit. At that time, there's about 5 million jobs to be filled. Down to here, at the bottom, right before 2010, there was only about 2 million jobs to be filled. God bless people who graduated college right around here. I graduated college right around here. But if you graduated here, oof, you entered the worst job market of all time. Right now, 11 million jobs open. So if people lose jobs, there's a lot of jobs to be filled. So number one, employers are already desperate to hire employees. So again, if people do lose their job, there's a lot of jobs open still. And here's the other thing. People have a lot of money saved up. So yeah, while the saving rate's gone down, look at this. The savings rate right now, I saw this chart posted last week. This savings rate went all the way down to 4.4%. That's below pre-pandemic. Green is normal. Green is the normal savings rate historically. 4.4 takes you back to like 2008. People were posting this chart saying the savings rate's back to Great Recession territory. And you are correct. The savings rate is back to, recession, 2008 territory as far as how much money people were saving. Here's the thing though. Look at how much people were saving at the beginning of the pandemic. Shot all the way up to like, what is this, 4% or so, somewhere in that vicinity. People saved up all this money. I'm going to show you another chart in a second here. Take a look at this. During the pandemic, people saved up around like 2.3-ish, $2.4 trillion. This is money they haven't even tapped. So they're still saving money, right? Albeit lower amounts of money. But they have all this built up. Trillions of dollars built up in savings that haven't touched. People saved up a lot of money. People's balance sheets are super, super, super healthy. Again, they are really highly qualified buyers. There's really no debt crisis, as far as like delinquencies and foreclosures and bankruptcies are concerned. And there's all this money saved up here. That's a lot of damn money saved up. Trillions with a T, trillions of dollars saved up. Here's another cool chart, right? Now this chart, this is from early April, but this chart here shows you household financial obligations as a percentage of your disposable income. Look at where it is. Now, granted, it's not at all-time lows, but when you go all the way back to the 1980s, we're near all-time lows as far as what people's, financial obligations are as a percentage of their personal income. Super, super low. Look at this. Going back all the way to the 1980s. Again, people's balance sheets are extremely, extremely, extremely healthy. Again, they're not in debt. Look at this. Not in debt. All-time high debt, 2008. Look here, near all-time lows. And this gets into inflation now, right? So core PCE is the, Fed's preferred measure of, measuring inflation. The inflation numbers come out tomorrow. So I would have done this webinar tomorrow, but one, people don't like doing webinars on Friday nights in the summer. Two, I don't do webinars on Friday nights in the summer because I prefer to be down the shore, right? So just to be blunt about it. But anyway, the number to look for tomorrow is the monthly number, right? So people will look at the number. The number is going to be high. They're going to say the number's high, but look at the monthly number more so than the annual number, because when they show like the CPI number, that's backwards looking. So if they show a CPI number in June 2022, that goes back to June 2021, right? It shows the year backwards, so it's more backwards looking. The number to look at is a forward looking number. So as an example, hypothetically, if like tomorrow is hypothetically this, I'm just throwing a random number out there. If tomorrow was 0.5%, that would mean looking forward that if that was to be 0.5 every single month for the entire year, that would be 6% inflation. Now here's the thing, inflation's starting to come down, but when inflation comes down, it doesn't mean prices come down. It just means the rise of prices does not go up at such a high number. And this inflation obviously is burdensome for, the majority of America and everything. And obviously, gas prices, are certainly, kind of like an invisible tax, as they say, towards people. And that certainly is not great. Gas prices certainly hurt a lot of things. They hurt the whole supply chain, right? Because everything that gets shipped to you probably comes on something like a truck that might, be fed by gas, right? When they have to raise prices, the end user has to raise prices. Those all get passed on to you. So, I mean, we need to get probably a little bit more serious about getting gas prices lowered, but I don't really see that happening anytime soon. That there are some, ways to do that and, put a dent into it, but it doesn't seem like, the current administration is, putting too much effort into that, unfortunately. So anyway, with this said here, inflation is starting to come down, but I also want to say if inflation does stay elevated, and it's going to stay elevated higher than what has been normal. Like normal has been, the Fed seeking like 2% inflation a year. That's, kind of been the inflation target, right? That's what, our government's been pursuing. But with that being said, it is looking like it's going to be higher for an extended period. The good news for us as real estate investors is real estate likes inflation. We'll talk about that in a little bit. So this here is just, a chart on this, core PCE here. So here's a chart on 5-year break-even inflation, which is about 3%. So I'll show you in a little bit that, well, actually you can see it here. Historically, we hover around the 2% number, right? So this is elevated for sure. It's higher than what is normal, over the past 20 years or so. So we are going to see, a higher rate of inflation, with some duration. Not as high as it is right now, but higher than what is historically normal, right? So again, it's important for us to keep in mind, how does real estate react to this, right? And here's how real estate reacts to this. Historically, real estate likes inflation. So the blue line is inflation, and the red line is real estate values. It's really, honestly, this is really only worth looking at after 1971. Obviously, in 1971, Nixon took the dollar off the gold standard, and we, kind of ushered in a brand new system. So, back here you could see it for historical purposes, but, really, I think 1971 forward is probably, where it's beneficial to look at. Only time you really saw a significant drop was here, right? The great financial crisis. And, with the 2008 financial crisis, we talked about this already. We had, low demand, we had excess supply, we had forced credit selling, we had funny money, meaning that there was, loans written out to anybody who could breathe. So you had a lot of forced credit selling here. This was supply driven, right? When you have excess supply of homes for sale and demand is, not so great, prices drop. But overall, historically, real estate likes inflation. Real estate's a good inflation hedge. Now, this was a study I, put together myself actually, and I posted this on Facebook maybe like 2 months ago, and I sent it out on my, my mailing list to our investors, just kind of showing like the 1970s was a decade of inflation. So I was kind of thinking, if we had a decade of inflation, what would it look like? So what I compared was 1970 to 1979. The left side here is the CPI, the right side the Fed funds rate. So I wanted to see how did, home prices, and real estate prices, get affected here. So from 70 to 79, median home sale price in the US went from 24,000 to about 55,000. That's a 128% increase in value, right? So then as inflation stayed high, Volcker came in with the Fed and he raised the Fed funds rate to 16.39%. So when interest rates, shot up, right? 16.39, super high. What happened to real estate? Well, from January of 80 to January of 82, over those 2 years, real estate prices went from 55,000 to about 62,000. So about a 12.3% increase. In other words, about 6.15% annualized. That's despite rates going up. So you see what happens here. And then, what happened after that? So from 82 to 88, what happened? Well, from 82 to 88, real estate price went from, median home sale price from 62,000 to about 87,000, which is again about a 40% price increase. So here's the thing. These numbers, these are unlevered returns. So when I say 40% price increase, that's 40% just in the value of the home. So if I bought that home with 25% down, hypothetically, most people buy investment properties 25% down, that means for every 1% the property gains in value, your return is 4 times that. Your return is 4%. So there's a 40% price increase, and I'm leveraged at 75% loan to value ratio, meaning 25% down. That's 160% return on my investment over those 6 years. And we multiply this times 4, 28% annualized. Not bad. Now, I always like to compare things to the stock market because I always say, what's my alternative? If I don't invest in real estate, what's my alternative? Now, my alternative would be the stock market, right? So from 70 to 79, how'd the stock market do versus real estate? The stock market did 12% total return, which over 10 years is 1.2% annualized. 70 to 79, real estate did 128%, 13% annualized. And that's if you bought with zero leverage. I put zero leverage here 100 times, right? Because the thing is, if you bought with leverage, meaning 25% down, That means that 13% annualized, you multiply that times 4, and that's 52% annualized, because very few people buy, property 100% all cash. They usually finance it. So if I bought an investment property with 25% down, that's not 13% annualized, that's 52% annualized. So 52% annualized leverage return with real estate versus 1.2% annualized in the stock market. Which would you prefer? I think the numbers speak for themselves, right? I don't think we have to get into that too much. But again, historically, this is no secret, right? Real estate is a great asset class. Real estate historically, kind of beats the crap out of the stock market. We're going to show a study on that in a little bit here. Here's a cool study. So this study was put out. I posted it on my Facebook page, I think earlier this week, but maybe last week. But what this study showed, this study studied from 1870 to 2015. Real estate versus equities. What it showed is that the average annualized return for both was about 7%, as you see right here. But when taking into account, compounding, real estate did about 6.6%, equities about 4.6%. And keep in mind, when you buy real estate, when you buy investment properties, you're typically financing that at 75% loan to value ratio, meaning 25% down. So if I put 25% down, right? If I put 25% down, this 6.6 multiplied times 4 is about 26.4. So net effective returns for real estate, if leveraged at 25% down, would be about 26.4 versus 4.6% for the stock market in equities. Shows you, literally, if you bought with 25% down, 75% loan to value ratio, between 1870 to 2015, again, we're not talking about like a 5-year window. We're talking about nearly a 150-year window. Real estate does about 6 times more. So it shouldn't be any secret why real estate has created, more millionaires than any other asset class, on earth. Real estate has withstood the test of time, and it will withstand the test of time. You need a roof over your head. I mean, this is why I don't really, and I'm not here to get off on a tangent on like cryptos or NFTs or anything like that, but I don't get involved in that stuff because it's not a necessity. I don't need those things. I need a house. One of the things I've also always wanted to invest in is cemeteries, because people are always going to die. People need a roof over their head. They're always going to die. This is going to sound morbid. I've been very interested in investing in funeral homes, things like that. I know it sounds morbid, but I'm really big on necessities, not things that are really speculative. So anyway, that's a little bit on this here. And this is just a chart kind of showing this. The green line is, housing returns from 1870 until 2015. The dotted line is equities. All right, so just wanted to mention some of my top sources, and these are people I think are great people to follow and find their content, whether it be on social media, whether it be through their websites, whether it be through their Substacks, whatever it might be. These are really high quality sources. I've looked into a lot of different sources. I read a ton of different sources. These I would say are like my top 10, 11 sources. So I would say probably my number one definitely is Logan Montashami. I love his content. Number one, it's very thought-provoking. Number two, it's very detailed. And number three, he's very engaging. So I have a Housing Wire Plus subscription, and for Housing Wire Plus subscribers, you can communicate with these people. So I'll have questions sometimes. I'll ask Logan. He'll respond within like 20 minutes, sometimes within like a minute. So again, he's great. I mean, he's a wealth of knowledge. Bill McBride, he has a calculated risk Substack. Again, worth subscribing to, definitely. Jay Parsons, he's a rental housing economist, puts out great data about rental housing if you're interested in that. Mike Simonson, an absolute must follow. He puts out a great 10-minute video every single Monday going over the current state of the market that week. He goes week by week. He doesn't show quarterly data, doesn't show, doesn't put out a report once a month, once a quarter, once a year. He puts out a report once a week. So you can stay really in tune with things. Dr. Lawrence Yoon, Chief Economist, National Association of Realtors. Tim Dye with Bloomberg, great source as well. Odetta Cushy, she's the Chief Economist with First American. Ali Wolf, Chief Economist at Zonda. John Burns with John Burns Consulting. He puts out a ton of good data. You saw me reference him a couple times there. Len Kifer, he's the Chief Economist with Freddie Mac. And Rick Palacios Jr., he works with John Burns. He's the Director of Research with John Burns Consulting. So these are definitely my top sources here. So, one thing I just want to make mention of, just to kind of wrap this up, as an investor, how am I kind of interpreting this data? This year, I'm a net buyer. I'm definitely a net buyer. This year, 2022, it'll be the most, active I am as on the buy side. I'm seeing it right now that some buyers are hitting pause. And I think the reason they're hitting pause because they don't have access to this type of data. They haven't done the research on this type of data. And as they hit pause, and there's less buyer interest in like apartment communities, let's say, whereas maybe we used to bid against 30 buyers, now maybe we're only bidding against 5 buyers. It's a huge buying opportunity, right? We're able to get into assets, high quality assets that otherwise, when we were bidding against 30 people, we would have had a tough time penciling them out. Now, we're having an easier time doing that because some buyers who just had loads and loads of equity, but they're not really following the data so much, some of them have gone on the sidelines. They've hit pause. I think if they saw this data, and hopefully they didn't see this tonight, they'd hit the gas. So anyway, I'm definitely a net buyer. And again, as I said, 2022, this will be the most real estate that I ever buy in a single year. So as I said earlier, if you guys, any of you want to be added to our investor list, because we do, take on passive investors for our apartment complexes that we buy, via syndicates, certainly feel free to email me. My email's there on the screen, Kyle Kovats at Gmail, and I'll add you to our investor list. And definitely keep in the loop for any future deals that pop up. And if we can get you in, we'll get you in. We'll try our best to do so. So anyway, thank you guys for tuning in tonight. Go Rangers, and I'll take a look at some of these questions now to see who has questions. But if you guys don't have questions, I just want to thank everybody for tuning in again, and we'll see you soon. So let me just take a look at these questions here.